My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Wherever I go, I hear death knells. The banking system's collapsing. The consumer's tapped out. China's going to crush us. Russia's running us over. We won't be able to get loans. Office real estate's crashing. The national debt's insane. To which I say sometimes, you need to take a page from Johnny Mercer and accentuate the positive a little more. Be a little more constructive. Owning stocks has paid off before, and I'll bet it'll pay off again. Just look at today. You could have easily sold yesterday if you were so worried. Dow gained 316 points. S&P climbed 1.3%. NASDAQ jumped 1.58%. And I'm not trying to gauge things by the day. I'm saying be more constructive. Attenuated sense of what really impacts stocks. Many seem to believe the market calculates things rationally and that it shares their own often negative assumptions about the way the world works. For example, the market must know that Democrats and Republicans will never get along, so Congress can't pass anything meaningful till at least 2024. They can't help the banks. As long as there's government dysfunction, they assume there could be no opportunity in stocks. People figure the market knows it'll be almost impossible to resolve the looming debt ceiling crisis, and that if one bank fails, they can all fail. The debt ceiling is worrisome, but it was 12 years ago and it got resolved. Oh, yes, the market fell 19%, peak to trough. But it did get resolved, and more important, the averages never really looked back until the COVID outbreak. It's just like that, and you had to buy. Still, though, what I want you to know is there's very little that's rational about the market on a day-to-day basis, and certainly not on an hour-to-hour basis or a minute-to-minute basis. Too many of us act like the market's somehow all-knowing and all-seeing. However, because of overwhelming negativity from the political media echo chamber, I think this market's become the sum of all our fears. And it stays that way until it gets so oversold that fear is wrenched from our collective consciousness for a small time period. Let me give you some examples. For the last week, we've been gripped by the fear of bank failures. The shocking decline and fall of Silicon Valley Bank and Signature Bank had everyone worried that we might repeat the errors and disruptions in the bank runs that we saw during the Great Recession. Now, it didn't matter that back in 2008, what we had was a credit crisis with banks lending and borrowing against bogus real estate concepts. That wasn't the case, and it is not the case here at all. This time, we have a mismatch between what banks own and what depositors expect them to own. And those depositors can easily leave bad banks for better ones because the depositors might be too big to be insured by the FDIC. Of course, you can flee. A worried depositor can flee with a keystroke, particularly a worried depositor who needs money. We were shocked by how quickly Silicon Valley Bank collapsed, but when you have a handful of huge depositors in the same industry who constantly talk to each other, and it leaks to social media, it's no mystery that the banks are gone or if they all decide to bolt at once. And it is terrifying to see a stock go from 267 to zero in less than 2 days. That's what happened to Silicon Valley Bank. It's even more frightening when another bank goes from 70 to zero over the course of a weekend. That's what happened to Signature, which had a similarly concentrated deposit base, except it was more crypto-oriented. Oh, then Credit Suisse, a bank we've been worried about for ages, had already seen its stock roll down to $2. Then you wake up the next morning and sure, it's worth half that. And it's merged with UBS at the urging of the Swiss government. A lot of bank debt wiped out before common stock. So when we see another bank, say First Republic, experiencing similar deposit departures, it's natural to assume that that stock's also going to zero, even if it was in the 120s just over 2 weeks ago, because that 120 price hadn't have been wrong, correct? That's certainly what people thought as the stock plunged from $34 last Thursday to $12 yesterday, even as it rallied 3.5 points today, although, again, it's selling off after the close. Which brings us to the current state of play as of, let's say, last night and today. See, we learned that Treasury Secretary Janet Yellen has had enough, and she has said that deposits will be protected if that's what they have to do. Now, we don't have it written in stone. It's not like anything that we can take to the bank, so to speak. But let me see. It does say that we got to start being more positive, does it? The big issue in First Republic isn't the quality of its loan book, which is pretty good, but it's an old-fashioned bank run where deposits are fleeing, even after a bunch of larger banks deposited $30 billion in the darn thing to stop the run. So Yellen's thin red line means the bank probably gets saved? And maybe we've seen the end of the crisis? Is that how the stock surged nearly 30%? Now, again, remember, until today, this market reflected the sum of all fears zeitgeist about bank stocks. Suddenly, some of those fears vanish. We catch a breather. Bank stocks bounce from a short covering rally. Perhaps more than a short covering rally, though. Could it be the genuine bottom? But whoever wants to be caught saying that in the YouTube age, so no one has any surety. Short term. Does it make sense for the market to behave this way? Of course not. Nobody knows anything about what's ultimately going to happen with First Republic. Nobody. It's about psychology. Maybe nothing's changed. Deposits are still fleeing. Maybe the FDIC ends up seizing it and the stock goes to zero. Or maybe everybody feels calm and hope springs eternal for First Republic because of what Janet Yellen said. Maybe yesterday's decline was insane. We honestly have no idea. But people sure don't act that way. They act so sure at that moment, and it's just unknown. What I'm saying is it's unknown short term doesn't mean it's unknown long term, which brings me to the second ridiculous example. Last week, when we were worried about which bank was next, the brilliant market sold any stock that requires a strong economy, especially the oils and the industrials, because if banks fail, well, won't those be crushed? Well, the stocks sure were, but not the businesses. Today, we discovered that First Republic may be saved and the regional banks might be preserved. So everybody rushes back to the oils and the industrials? Yes, they're flying, but they're barely related to this crisis in any way. It makes no sense. It gets dumber. When the industrials and the oils and the banks were getting hammered, the market rushed into the safety stocks, recession-proof plays like food and drug concerns. Those were pummeled today because, well, First Republic seems safe, or at least safer than yesterday. And then a final dose of stupidity. The market dove into tech last week because tech wins if the Fed stops tightening and bank runs might make that happen. Today, though, tech initially sold off as last week's rotation reversed itself. Then we got buyers rushed in to buy Alphabet and Meta. There's some positive commentary from analysts. And by the way, the Meta did have a declaration. The analyst did say that revenue growth is going to be up, and that would be gigantic for Meta. And the Alphabet, that was just some analyst saying, you know what, I think it's the right time to buy. But guess what? We saw real good news from another company, and that is we saw great news from NVIDIA. And that's a very different situation. People are much more excited about NVIDIA because they should be, because they're talking about generative AI, and it's suddenly become mainstream. It's the iPhone moment, says CEO Jensen Huang, and he's got the best technology to power the stuff. We have Jensen on the show tonight, and I've got to tell you, his speech today made me think anything you can do, NVIDIA can do better. NVIDIA can do anything better than you. Yes, with apologies to Andy Oakley. That was the only thing I've heard in the last 48 hours that is of any significance was NVIDIA. Everything else is just emotion. Final bit of market stupidity. There are plenty of people who didn't want to take action today because who knows what Fed Chief Jay Powell will do tomorrow or how it'll be received by Wall Street. Will he tighten by a quarter point, possibly sending a sign of strength? Will he leave rates unchanged, possibly a sign of weakness? Or does it even matter at all? Well, it matters to those who are fearful, but it doesn't matter if you think we're closer to the end of the tightening cycle. That's what's important to me, because stocks do better when we're no longer fighting the Fed. If Powell stands pat or only tightens by a quarter point, there's no denying it. We're coming to the end of this rate hike cycle. And I'm hoping this idiotic market actually understands that that's good news. Here's the bottom line. Now, I'm not saying you can ignore the day-to-day action. I'm simply saying that anyone who thinks they know what's going to happen in the next hour or two has been proven wrong this time. But if you take a longer view, owning stocks of high-quality companies that have good balance sheets, history says you tend to be a winner. Pat in Texas. Pat.
Yes, thank you, Jim, for taking my call. Thank you for all you do.
Thank
I'm an
you.
Investing Club member, and
Yes.
thank you for all your charity donations through that. My question is on Home Depot. The balance sheet, it has a total assets of $76 billion, total liabilities of $74 billion, long-term debt of $42 billion, cash in hand of $2.7 billion. With that kind of balance sheet, is Home Depot a buy?
Well, remember, Home Depot does have to borrow in order to be able to just do its business. It actually has a great balance sheet. Anybody who looked at the balance sheet during 2008 recognized this company is one of the most conservative companies on earth. They have gigantic free cash flow, too. I like Home Depot here. Now, am I worried about it? Again, it's just like I said at the top of the show. I don't know if Home Depot's having a good day or a good week or a good month. I just happen to think that Home Depot's a great franchise. Now, I say it pays to be constructive over the long haul. So what's with all the negativity out there? I think it's very misdirected. Well, Mad Money tonight, Huntington Bancshares is caught up in this regional bank crossfire. So is this a name that investors can rely on? I'm digging into the details with the company's top brass. Then NVIDIA, as I mentioned, held its GTC conference today, featuring a ton of new announcements on the AI front. So what did we learn from Leonardo da Vinci himself during the keynote? Don't miss my exclusive with NVIDIA's founder and CEO, Jensen Huang. And Mary Dillon, formerly of Ulta, is now at the helm of Foot Locker. And I'm learning more about her vision for the footwear retailer and see if the stock could be a perfect fit for your portfolio. I'm thinking positive. How about you? Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.